Hey, David, how's it going?
Hey, good. Thanks. How you doing, man?
Good. Season two is officially underway, and I love that we're starting off with some very practical, very timely updates. I think this is going to be a great episode.
Yeah, for those that are listening in real time in April 2023, I'm sure you're seeing the wild ride that mortgage rates have been on, not only for the last 12 months, but even just like the last 12 days. I mean,
Right.
just very recently here, mortgage rates have been fluctuating quite a bit. And what may not be as much in the headlines, though, is the mortgage rates or the mortgage rules and fees behind that's shifted and is shifting. And that can really impact real estate investing strategies here in 2023.
Yeah, and that's why we invited Josh Schaendorf on the show today. He's a loan officer that David and I have both worked with personally for mortgages on rental properties and properties that we own. And he's a very well-versed lender in the both owner-occupant space as well as the investor space. So just an expert on all these pieces. So the perfect person to come in and talk about what's going on in the market and how it's been changing.
Yeah, and not only just what's going on, but how you can apply that to your real estate investing strategy. So, for instance, the BRRRR strategy, or where you buy, rehab, rent, refinance, repeat, that strategy can get stirred up if you are planning on a conventional mortgage with a cash out refinance with kind of the traditional 6-month seasoning period that we've had, as that shifts to 12 months. So that can be a big deal. If that quick snippet doesn't make sense, Josh will break that down, and not only break that down, but also talk about other loan types, such as a DSCR loan that might be an alternative for a faster refinance if that really messes up your strategy.
Yeah, and I like that he also mentions a couple great things for those that might be considering house hacking. I know this is something that I've helped a couple of clients with myself, and it's one of those things that, again, I wish I would have knew what house hacking was back when I bought my first house. And Josh talks about some of the changes coming to the FHA mortgage space that might apply there for an investor. So it's not all doom and gloom in the investment space and in the lending space. There's some options out there, and Josh goes over quite a few of those.
Yeah, and I think the really potentially scary part is if you're missing this kind of news. If you're basing your 2023 strategy on 2022 rules because you're just out of the loop with some of these updates, that can really be a scary surprise at the end. So I feel like this episode is one example of why staying current and keeping up with these details really matters.
And it's a perfect example of what we're trying to achieve with the new season of the show. So with that, we'll take you guys into episode 1 of the second season. Hope you guys enjoy. Hey, Josh, welcome to the show.
Hey, thanks guys for having me.
Yeah, absolutely. We have worked together for several years, all three of us, in fact. And so we knew we wanted to have you on to talk all things lending.
Yeah, I appreciate it. You guys have been great to work with, and I'm happy to share anything I can to help people be educated in the mortgage process.
We appreciate that. So why don't you just jump right in, give us a little bit of a brief background on yourself.
Yeah, absolutely. So I've been in banking for almost 25 years, believe it or not, specifically in mortgages since 2015. And I recently moved to a brokerage back in November. So big changes there. Been on the retail side of it. And honestly, if I would know what I know now on the broker side, I probably would have done it much earlier. Lots more flexibility and absolutely an opportunity to bring more to our borrowers and our clients on the broker side.
So I definitely want to get to that issue of a mortgage broker versus a bank and some of that nuance. But let's pull back and start with kind of square one of the purchase process. Like if we just walk this through with where someone gets started in the purchase process. If you haven't bought a house before, one of those first steps is to get pre-approved for a mortgage. We hear a lot of terms like pre-approved and pre-qualified and what that process looks like. Can you walk us through for a minute what that looks like as far as getting the information and getting that determination and letter so that someone can start shopping for a home?
Yeah, absolutely. So the difference between a pre-qualified letter or getting pre-qualified versus getting pre-approved through a lender or a broker is what's collected up front and gone through initial underwriting. So to get pre-qualified, person submits a loan application, they put down their income, their liabilities, a credit report is pulled, and then automated underwriting, we call it AUS, is run through either Fannie Mae or Freddie Mac. That sends you're either approved eligible, or approved ineligible or caution. There's ways we have to figure out how to get you pre-qualified based on what was entered. It has not gone through the underwriting process. A pre-approval it's actually the data, the credit documents have been collected and actually sent through underwriting initially to pre-approve you. So an underwriter's actually looked at that pre-approval. There are different software based that kind of act like artificial intelligence underwriting. So if you get a pre-approval as well, it's basically exactly what an underwriter would underwrite. And that would be considered a pre-approval that way as well. But pre-qualified is just basically you're going on the honor system, whereas a pre-approval has actually been through some type of underwriting process. Much stronger when you're looking to buy a home if it's been pre-approved already, where you're just looking for a property. Lots of real estate agents, if you got that, you're going to move up to the top of the chain when you're submitting an offer.
Yeah, firsthand, right? As a real estate agent, I need a buyer that has that pre-approval in hand rather than the pre-qual letter. So yeah, fully appreciate that comment.
Yeah, absolutely.
And I'm curious too about having a loan officer kind of work through that, because I'm assuming that there's a lot of questions that follow as someone provides a little bit of information that probably generates questions and then more information and questions. And so I'm curious what that looks like. And then also, what are the things that you've seen that can break someone's pre-approval, or even in the midst of the purchase process, what might someone do that could ruin the chance that they could close on that loan?
Yeah, absolutely. So the biggest piece of it is getting the income and the liabilities correct. There's certain calculations that we have to follow through Fannie Mae or Freddie Mac, and those are the companies that actually buy the mortgages, right? So they write the rules on what they want when a bank sells that note or the paper to them. So when you're looking at those questions, are quite different for someone who's self-employed, right? So you got a W-2, someone who gets a W-2 wage income on their taxes every year versus someone who's self-employed and gets a 1099. There's different rules for each of those. You could go from one job to another with a W-2 and as long as it's in the same industry, and there's really no gap in how they count that income. If you go from a W-2 to a self-employed 1099, now there's a 2-year history that you have to have established. So, and a self-employed person may have write-offs, so they can write certain expenses off, whereas a W-2 income person can write them off and that doesn't affect your income. But on a self-employed, it does. So you could net $200,000 in cash that you actually made, but by the time you wrote expenses off, maybe you're at 150 or 100,000. Much different on your qualifying income piece, right? So those are things that you definitely have to get right, and a good loan officer has to do that. And those are the things would actually absolutely would break your pre-approval. Someone not verifying or reporting your income correctly. So when you get the pre-approval versus the pre-qualification, if a loan officer doesn't do their homework on the pre-qual, you can have a pre-qual that's really good because they've done their homework. Like, hey, I want to see your pay stubs. I want to see that piece of it. As long as you get that right, the pre-qual is probably pretty solid. But going through underwriting, if you have more time, I would say get the pre-approval. People that call and say, hey, I just saw this house. I need a pre-qual letter here, in the next 30 to 45 minutes, because we can get that done if we do our homework to get that offer in. So you definitely, there's time is everything when you're putting in an offer. But if someone says, hey, I'm thinking about buying a house, that real estate agent hopefully gets them over to you right away, or you find that borrower because they come in, you're referred by someone. Then you can run them through the pre-approval process, which helps it be a stronger letter. So we started pre-approving everybody back when it was crazy in 2021 because offers were going in about 30 seconds, right? So how can you make yours more attractive? And that's the kind of thing we did. But, if what breaks it is them not being honest on their application or not disclosing everything. And then as it goes through underwriting, we find out they have more liabilities that they actually reported or more properties they owned. And that affects their debt to income ratio. So what they make income wise versus the liabilities that they pay, there's certain ratio thresholds that they have to meet.
Yeah, I think that there's a lot of pharmacists that are probably planning ahead really well like that are definitely good at getting that information in ahead of time. Kind of the double-edged sword of that is there's probably pharmacists that are planning ahead and they get really excited. Oh, I'm going to buy this house. Now I need to go get this furniture, this appliance set, or this thing here. So Any risk in doing those kind of things right before purchase, where it seems like you're getting your ducks in a row, but could that jeopardize a close as well?
Yeah, absolutely. We always tell people, do's and don'ts for new buyers we hand out to them. And a big don't is don't go buy anything new until you talk to your loan officer, because you don't want that to affect their ratios right away, right? As far as that piece of it, again, the right loan officer getting the right property tax prorations, not the current homeowners, but what the purchase price is going to be, that can break a deal. If they change jobs, go from a W-2 employee to, hey, I want to open my own business. Now I'm self-employed, but I've been in the industry for so long. Well, we can't count that income then. So, or maybe they lose a co-borrower on the application and they don't have that piece as well. So yeah, definitely talk to your loan officers before you say. It might be as like, yeah, you can go ahead and buy it. Everything's great. Just get me all the documentation that we have so we can give it to the underwriter. The more transparent we are with them up front, the easier it is for it. They don't like to be surprised in any way, because then what else are you hiding comes up. So definitely want to be transparent.
Mm-hmm. And one of the things that I've seen in working with buyer clients and even in the selling space too, is people who are interested in investing. They go and they get pre-approved, for example, for one type of loan. Maybe it's an owner-occupied loan. And then they pivot and they don't tell anybody, right? And it's like, oh, well, never mind. I'm not going to live in the house. I'm actually going to buy it as an investment property. And so even just asking those really good questions up front as the loan officer can be extraordinarily important in understanding that real estate investing strategy. Just maybe generally, just so people can understand why that's important. Like, what are the differences between an owner-occupied loan, like your traditional, what most people think of when they think of a loan, and an investment property loan?
Yeah, absolutely. Great question. So owner occupied it's your primary residence. And in most states, you sign a letter saying, I am going to be living in that house within 60 days. And your tax prorations are almost a third more if it's an investment property or second home. So again, everything on the qualifying process is about the ratios that you fit into, right? We can look outside the box on certain programs that like FHA loans, for instance. You can only have those as primary residence, right? But they'll allow your debt ratios to go up to almost 50% versus a traditional mortgage. It might be 44, 48% if good credit. FHA, not so much good credit, maybe. And what's good credit? Well, according to FICO and Fannie and Freddie, anything over 740 is considered pristine, really good credit. Anything above that, 720 to 740, there's certain overlays. So when you mentioned primary residence versus a second home or investment property, there's higher risk in a second home of default or an investment property. Are you more likely to walk away from those versus your primary? Absolutely. So the market gets those priced in. We call these overlays. So these overlay pricing to fix the adverse risk that's out there. So if it's an investment property, there's going to be, they call them loan level pricing adjusters. So there's going to be higher LLPs on these investment properties and second homes, and how much you put down, right? They do require more down, but again, there's more risk to that, as far as walking away from it. Whereas we believe your primary residence, not so much. Also, your property taxes are going to be higher. Again, another risk that they have to look at. So owner occupied, definitely, we just locked someone in. Now rates kind of bumped up in the last week and a half or so, but I just locked one in about a week and a half ago at 599 on a 30-year fixed primary residence.
Nice.
Still not bad. We hear, oh, they're like 7 and what there is if it's a condo, it's a second home or investment property. Then the rates are going to get up there quite a bit higher. So definitely, there's the investment is a great, and I saw you have some notes later on a different type of loan to talk about. That's how I would kind of attack if you're looking at an investment property.
Yeah, let's jump in a little bit more, particularly because I think that investing strategies seem to be shifting as some of the market shifts, right? Like you mentioned with having to put more down and higher interest rate, higher taxes for that typical investment property, something that you are not going to own or you're not going to occupy as the owner. That starts to look less and less favorable as the market continues to shift. One strategy that I think I'm hearing more and more about people being more willing to jump into is occupying that property that becomes the investment. Some of that like live-in flip property, buying a fixer-upper and then fixing it up as you live there, or buying a duplex, living in half of it. So in that sort of situation, even though you are kind of working towards an investing strategy, it's not considered an investment loan. An FHA loan would be an option then. Is that right?
That's correct. Where you could have live in the one side as your primary residence and rent out the other side, right? So you can make some money on that piece to help make your mortgage payment, get some equity built into it, and then maybe down the road you pivot from there and sell that. Now you have that rent the other side out as as the investment. You got two investment properties there that you're working with, and then you got your primary. But yeah, that's definitely a strategy to get it. On the FHA is a really good opportunity, because obviously we just talked, or we're going to talk about, they're going to lower the upfront insurance, the mortgage insurance on that piece of it, versus what they're going to do. And this is just fresh off the plate today, that those costs are changing. So yeah, definitely it's a good strategy if you want to get a duplex, or if there's the DSCR loan, which we can talk about. I don't know if you want to go on that now. That's a really good way to jump into getting in the investing side if you have some cash for the down payment. And what that is, it's a debt service calculation loan that the property funds the credit, right? So we don't take your personal assets to underwrite the loan. We take the rental properties of that particular property. And if the rent schedule says, hey, it meets a certain ratio, then all you need to do is come up with the down payment, the source of the down payment, and the property actually funds the underwrite or the credit worthiness, versus you having to, it's great for self-employed people, right? So they don't have to have that 2-year self-employment history. They just need a down payment. And why that's favorable is the interest rate versus you personally putting the money down on 20 to 25%, versus doing one of these non-qualified, non-QM loans, they call them non-qualified mortgages, is the rates aren't really any different. They have the same type of overlays. So, less risk for you using your personal credit, frees that up to do something else, versus being, having it, scaled down your debt to income, funding another investment property. So those are really starting to get a lot of legs. There's another program called the bank statement program. If you have lots of deposits in your bank statements, it's also a non-qualified mortgage that you can buy investment properties with as well. And we don't take your personal tax returns. You just got to, provide 12 or 24 months bank statements.
So I know we hit some alphabet soup there. I want to back up for just a minute, because we have FHA loans, we have DSCR, and we have this MIP fee, the mortgage insurance premium fee. And so if I'm catching this right, the FHA loan can be a great way to have a very low down payment, even if your debt to income ratio is high. So I'm thinking a lot of new pharmacy grads that still have a lot of student loans hanging around. It can feel like you're trapped and unable to jump into investing, but an FHA loan could be a really good fit for that owner occupied property. At the same time, a DSCR loan might be an option if you're stuck in this debt to income hurdle or something like that, and you're trying to find a property that's more of a traditional investment. You're not going to live in it. Does that sound about right on those two?
That's correct. So the FHA one, 3.5% down is what the requirement is. And two ways to look at FHA in the industry. It used to be, and we had to educate realtors. If you heard an FHA offer that came in, they're like, oh no, absolutely, I'm not going to win on a conventional. And it's not. I mean, some of these FHA pre-qualified clients have phenomenal credit. They just don't have the down payment. So they only have to go with the 3.5% down. Now they've combat that. There's some 97% loan to value loan programs through a lot of lenders. And, we use UWM has it's called Borrow Smart, and they'll actually give you some money towards your down payment as well. And that's the 97% loan to value. So the conventional side's making up for it. But let's just say they don't have great credit. So now we got to go back to the FHA, and some of the changes that they're making are to benefit people with not great credit that have had lots of maybe student loans, or they made bad choices and now they're trying to get into home ownership and change things. So they've lowered these MIP fees and some of the loan level pricing adjusters as well. So they're not as high with the lower credit score. So obviously the people with the top credit score are going to get the most favorable rates. So it's very risk adverse in our industry as it is in insurance or anything else. Also, when you look at, so that's how the FHA can be a great period to get into the duplex loan or just your own first home. The DSCR loan, that's more of, hey, there's really no advantage to use your own resources in your own name to buy an investment property, because the loan level pricing adjusters they changed last year for second home and investment properties became so high to kind of slow that process down. But people are still going to buy them. So at that point, these new programs have come up to kind of free up your own personal assets. And how can we get them if the property actually funds it? And the cool thing is we've got a calculator. It's called a home value estimator. And we actually brought some local appraisers in and said, hey, can you give us some of your properties to tell us what you believe they're worth? And that value estimator that we use from UWM, can pull comps. Nate, you'd love this. Can pull comps in a region in about 30 seconds. I can probably do what you did in 4 hours. It's absolutely, and the realtors that I'm working with are like, this is absolutely amazing. So we had these appraisers in, and we were within about $2,000 of how they're appraising stuff. And we were only missing out because maybe they did some updates to some bathrooms and stuff like that. Cool. So this property estimator is absolutely amazing. It's I won't say it's spot on, but it's pretty close. And there is a version, if you change some things, we can actually put that into it and it'll actually recalculate the that's like a paid service fee. So there's that piece of it. And then again, the bank statement loan is another one. If you've, hey, I got lots of cash flow that comes in and out, but maybe I don't have the resources on a traditional mortgage to show through my tax returns or whatnot. So those are just other ways to help self-employed borrowers to get qualified.
So I'm sure a lot of people are listening right now and are like, "Wow, these are great ideas. How do I where do I go from here? Who do I go to get these resources?" Is this something that every lender can do? Is this, maybe why a broker might be a better fit for some people? Talk to us a little bit about how someone can tap into these resources and start to learn more about what might be a good fit for them.
Yeah. So, you can actually go, there's a website like findabroker.com, is one for local brokers if you wanted to do it. But no, not everybody has these things. This home value estimator, it's funny because some of our agents like, hey, can you send me that so I can do it? Well, no, you got to be a lender and you got to be partnered with United Wholesale Mortgage, as far as that piece of it goes. So, but yeah, you definitely, there's a part at the end, and I'll come back to that at that point too, is find a mentor. You guys are great mentors in this space for pharmacists. You guys have been through it. You know the ins and outs, and then a lot of context because you've been into it. So I always say, find a mentor and work with them. I've got a new loan officer I'm working with, just a phenomenal person, needs lots of training, right? So all of his deals, I look at him, I see him, I go through them, but he's going to be phenomenal in like 3 to 5 years. But somebody had to give someone a chance, right? You needed to start somewhere. And so that's what mentoring, we don't do enough of that. And I think in this world, so when you find someone, mentor them. But, as far as local lenders, findabroker.com, brokers are different than banks. And we have different, we can all do mortgages, but we do them a different way. For instance, there's so many layers to how you do a mortgage in a bank and a credit union, where there's different pieces of the pie that everybody wants to get their hands on. And that ends up driving up mortgage rates with those institutions. Didn't know that till I got to the broker side. Well, it's just us and like who we go find, there's some brokers will go work with Rocket. Some will go work with UWM. Some will work with Home Point. we can go and see where the best options are for that borrower. And then there's lender paid fees and there's borrower paid fees. So you can flip to either one of those, as far as how the loan fees are charged, right? And so there's flexibility in that on the broker side, where the lender is always lender paid fees, right? They're going to have all their underwriting fees, their processing fees, and you got all the title, the boilerplate title fees, appraisal fees and whatnot. But there are appraisal waivers, depending on property and down payment, that people should be looking for and asking for. Hey, can I get a waiver on it? Some lenders can get it, some can't. Well, hey, appraisals are averaging about $500+. So that's a good savings right there. If you can get it, it's worth shopping just for that piece.
No, I like that a lot. There's a lot of shopping around, a lot of creativity that needs to go into the market with where interest rates have gone and all the changes lately. I know one thing that doesn't get talked about a whole lot right now is refinancing, given how so many people are sitting with a really good rate. But I think there's some hope that looking a few years down the line, we may not see rates as high as they are right now. Refinancing may become a thing again. So kind of in this market shift, I'm hearing this phrase, marry the house, date the rate. So can you walk people through like what that means and what's the logic between like maybe buying a house now, even if mortgage rates aren't great, with a plan to refinance later? Like what does that strategy and philosophy look like?
No, yeah, great question. And yeah, that was kind of created back in 2022 as the rates started peaking up, right? So you got to love the house if you really want it and be there and know you're going to be there for the long term. So that's the marry piece of it. The date part of it is as soon as I can get out of that rate on a refi, when they go down, I'm going to get into it right away, right? So I'm going to drop it down. Every conversation I have with borrowers is the rate today is not where you're going to be in 18 to 24 months, because we believe rates are going to come down in that time frame, maybe sooner, maybe a little bit later, but pretty much that's what we're seeing with the data. So we tell them like, hey, trust me, I'm calling you for a refi. We're going to do it. We explain it. There's ways to be creative on the refi too. You're not feeling like you're paying double closing cost versus, your monthly mortgage payments. And for instance, today, if we're coming into March 1st, if you had a refi come through and you close on March 1st, you don't have all of March's payment, all of April's payment, your first payment's in May. So you've got 2 months worth of payments to cover closing costs without going backwards, right? And if there's enough value in the rate, if they come down, maybe you can refi some of that cost within the rate itself. It's called a lender credit. So there's definitely ways to do that. But yeah, refinances, believe it or not, I actually just did one because they're rare right now. And it was on a 15-year. So we went from a 30 to a 15-year. Rate was 5.25%, which is okay. It's not great from where they were in the mid 3s, 4s, but they were looking at doing a home equity loan, right? So home equity loan pricing was 10%, and their current primary was like a little over 4%. Well, I did a blended rate calculator and say, hey, based on how much you're going to have on your equity you need and how much here, it was almost the same as I could get them on a 15-year, and they were in a 30. So I cut, like 12 years off, and we were right there with what the rate was. Totally made sense to do it. Now, part of it is you're going to refinance out of that because 15 years better. Maybe we get you into a 10 when they come down. So again, it's always going to be part of the conversation is today's rate. It's not where you're going to be. These are really short term.
Since you mentioned refis, Josh, I think the other thing that comes up a lot with investors in the investing space is the idea of like a BRRRR, for example, right? Or people are going to buy a place, fix it up, do a cash out refinance once that project is complete. Now all of a sudden they've got this great, investment property and they don't have anything sunk into the deal. But there's a big change that has just come up, and I thought we'd get your take on it. Maybe start with us a little bit about maybe like what is a cash out refinance, because I think that a lot of people are confused about that. Let's start there, and then we can dive into some of the changes that have taken place over the last couple of months.
Yeah, so a cash out is sometimes people will put quite a bit down on their property when they buy it, right? So they've got equity, or the market over the last few years has continued to raise home values that 6 to 8% annually, your home's increasing. So you're gaining equity in there. So let's just say maybe you bought a house for 200,000 and 5 years later, and in this market, it's worth 300,000. So you got $100,000 equity. And people said, hey, I want to do some upgrades to our house, our lawn, consolidate some debt. So I want to take some cash out. So it's called a cash out refi. So we're paying off that whole first mortgage, just like I had mentioned in the one scenario, and we're giving you cash to, pay those things down. So you don't want to have multiple, like I got multiple credit cards, I got vehicles. I want that together. I only want one payment so I can concentrate on it and really throw all my income power to that. So you would pull that equity out of your house because you've earned it, and consolidate those, pay that, so your mortgage balance goes up. But that's what the cash out piece of it is. And yeah, there is some definitely changes that are coming here. February 1st is when they kicked in.
Okay. And so, because there's two types, right? So let's say someone just bought a place and they're looking to do this cash out refi after investing some money in it. There's a delayed cash out refinance, and then there's the kind of more traditional cash out refinance. And it's that second part that's changing, right?
Yes. So the delayed financing, if you purchase with a cash transaction, like you bought the house, like, hey, I got to close, you want an offer versus someone doing a mortgage, whatever it may be, you pay cash for it, and maybe you do some upgrades, or you're like, hey, I had to, take some of my cash here or savings to buy this. Now I want to replenish it back. So that's called the delayed financing cash out. Those aren't changing. 6 months, within 6 months, you can still do that. Doesn't mean that they won't change it, but right now those are safe. You can go in within 6 months. You have to pay that original source where you got the, so if you had a home equity line, or, you had some type of personal loan or whatever, you did it, those funds have to go back to the original source to do that. If you paid cash, you didn't have it, it's sat in your bank, then it goes back in your bank account. Now, the traditional cash out refinances, they're going to have a 12-month seasoning. 12-month season. It used to be 6 months. So there are some exceptions, though. Like if there is certain exceptions if there's like two owners on it and maybe one was deceased or whatever. There's Fannie Freddie has certain guidelines where they'll like give you an out less than the 12 months, but they're pretty firm on the 12 months. Now, there is what's called a rate term refinance, which I want to mention. That one is your rate and terming it. So it's like I mentioned here, as rates come down, we're going to rate term. You don't need cash out. You just want a lower interest rate. So you can do those. I believe if you're not getting cash out, those still might be 6 months as well, but I would have to double check on that. So because you're not getting cash back, you're just like, hey, I want to get a lower rate. I believe it's 180 days, which is, I believe, 6 months. You got to do that. If you do that before that, there's some fees that go back to the lender and whatnot that they have to pay back.
Gotcha. And what if someone can't wait 6 months, like 12 months, right? Because what I see, or what I'm worried about is somebody who bought a deal in December, right? And they're going through a BRRRR. They've got $100,000, let's say, more in a hard money loan at 12%, and it's due in 6 months, or it's due in 7 months when they're going to do their cash out refi. Now they're sunk. Like what other options do they have, or do they just have to sell?
They'd have to sell. I mean, there's really, they'd probably lose that and maybe find someone they could, help float them the money for a bit. They're pretty much now, again, the lender and hopefully the real estate agents, like you guys are understanding, is let them know they're going to sign paperwork on their closing that says that they can't do that prior to 12 months. So it's going to be there. So you definitely want to make sure they're going into it for the right reasons.
Yeah. I think too, that speaks to a lot of the value of, we talk often about multiple exit strategies and thinking about, it's great to have kind of a desired option of, wouldn't it be great to do this cash out refi at 6 months? Well, but these rules can change, right? It's now 12 months. So could you sell this property and treat it like a flip? Or maybe there's a DSCR option, or maybe there's another lender that you could borrow some cash from to float you until this investment moves forward. And so I think, pharmacists tend to be pretty risk averse and think through a lot of this strategy. And so this can be a great opportunity to just think about, well, let's have a plan B, because these rules we think are fixed, they aren't always fixed.
Yeah, I like that a lot.
Absolutely. Yeah, definitely got to have plan B.
Well, Josh, I want to jump now to our final infusion questions. 3 questions we ask every guest on the show. Get your take on this. So, what is one tangible strategy that you use to make sure that your personal investing, whatever that looks like, and your financial planning, how does that work hand in hand with your career?
Yeah. Well, funny thing is when my wife and I got married many years ago, we actually had someone introduce us to Dave Ramsey, like within a couple weeks of each other. So we're like, okay, this is something. So we went to one of his live events and we saw him. And the biggest thing I got is you get on a budget, and if you got a budget, you have an emergency fund for your emergency fund, so, and I remember those were really painful in the beginning. I mean, we had like hour-long budget meetings and agonizing, right? And it's just like, oh no, we got to do these things. But, I remember her when we decided we want to have a family. It's just like, hey, I'd like to be done working to have some time with the kids as they're going through life. And that was always our main goal. So one is you get on a budget and you set your goals and you talk about those goals all the time, and they're totally tangible. It's the mindset, right? So we literally year after year knocking it out. Yeah, that we got it. And we're going and got that snowball rolling to get rid of things. But because you have to live like no other to live like no other. Mm-hmm. So then you get to go do all these fun things because you got your stuff in line. And a lot of people want to go like, I want to get this investment stuff going. I want to get this strategy, but let's take care of your primary stuff first, get that in a good spot. And then, like you have your securities and your investments, the investment properties can be another piece of that overall investment that you have. So that would be the biggest thing, is get on a budget and set that goal it's attainable if you believe it's attainable. And I'm reading a book right now, and I could get back to it. It's called Sales Ninja. And it's all about mindset, right? So they describe in there like, hey, I want to lose, 15 pounds. I want to be 175 pounds. Well, your mind doesn't think that side of the brain, right? But if you say, I feel good at 175, you'll start doing the things that make you feel good because that's where you're at. So it's all mindset. And that's the biggest thing, as far as that piece goes.
I like that a lot.
Yeah, that the goals and mindset, that's so good, because whether it's the hour-long painful budget meeting, or whether it's the habits to change to lose the weight, or whether it's, you're painting a house in the evening after you get off work, like whatever those pain points are, if there's that why and that goal behind it, that can be really motivating, keep you going in those tough moments. So I like that a lot. What's one resource that has been most helpful to you in your career journey, whether that's a book, podcast, person, author, website, whatever that would be?
Yeah. So I mentioned the mentors, right? You find a mentor that works really good. So, I have a really good friend I went to school with, and we kind of mentor each other, whether it's, day to day, spiritually, it's always uplifting, right? So you do have that. And we're both Dave Ramsey guys, right? So, whether it's Financial Peace book, the Total Money Makeover, and then as they continue to grow, now he has Entre Leader, right? Mm-hmm. And then Dave's also partnered with, there's one about Everyday Millionaires. Like once you get to there, how do you get to that next year? So it keeps going and it keeps you motivated to get to like, I'm here. How do I get to the next step? Right. And we always, the discussions I always have with my wife is, the why you mentioned, Dave, like, why do we get up in the morning and do the things we do? Well, because, we've had 3 kids that we want to be able to, wherever they move someday, we want to go be where they're at, or provide for those things, or take them on a trip, or do something, that they don't have to think about, but it creates memories, right? So that's kind of our why. That's why I get up and do what I do, but I love it. That's the thing, is I'm like super passionate about it because I enjoy what I do. You find the thing that you really like doing.
That's great. All right. Then if you were to give advice, one piece of advice to a pharmacist contemplating a start in real estate investing, what would that look like?
Yeah. So what I would tell them is, go with my trifecta here. Go find a mentor that's done it before, right? Go find someone that's, been through there, and they can save you a lot of time by just listening. Like, hey, this is what I did to get started. There's going to be roller coasters up and down. It's all rosy as just owning a piece of property. Who do you emergency fund? Who do you have to fix something if something goes wrong in the middle of the night? Who do you have locally? If you buy something in one part of the country and you're there, who do you have that's going to take care of that you can trust and call on that, especially if there's people in there, you're the landlord or whatnot. It's not just showing up, the proceeds in your bank account. It's having those people that have done it and said, hey, have you thought about that? That's the biggest thing in homeownership, right? Too, people like, I want to put so much into it. And I said, unless you buy a new construction, hang on to some of your money, your cash flow, to once you get into the house and say, gosh, I didn't see that when I went through the walkthrough, right? The house, like you see, like all you see is like new house, new excitement. And you get in there a while, so I never noticed that when I walk through, or, I want to change that or whatnot. So you don't have to come back and we got to, do another loan to give you money you already had. So I'm not always a big in like taking people's fees and stuff like that. That's not what it's about. So I always say, be patient, go through it, then see it. And then if you're like, hey, we're good, we're at, then you can take that and put a principal reduction on your loan and pay things down so you feel better about it. But that'd be the biggest thing. Find a mentor, someone that's doing it, so that you don't have to rewrite the wheel every time you go through.
Good advice.
Love it. It's been great to work with you over the last several years. It's been great to talk today. If people want to reach out and get in touch with you, how would people find you?
Yeah, so I'm actually on the findabroker.com, but no, they can reach me. The easiest thing is my cell phone, 616-4023-998. You guys have my contact as well. Josh at hometeammortgage.com is the other piece of it as well.
Perfect. We'll make sure to put that in the show notes, and you might be flooded with text messages after this goes live, so just be warned. So,
hey, that's okay. That's what we're here for.
Well, Josh, really appreciate you joining us tonight and going through this great information. You're a wealth of knowledge on the subject, so just appreciate you being here.
All right. Thanks so much, guys.
Thanks so much. Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard in today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with us, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group.
As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content of this podcast is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in this podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with their financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and therefore may not be accurate at the time you listen to it. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer.
Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.